Ever asked yourself, which ETF can turn a $100,000 investment into a 9-figure return? In today's video, I'll be comparing two dividend powerhouses, SCHD and NOBL, to see which one could make that dream a reality. I'll explain the differences between these two ETFs, covering their strategies for generating returns and the potential risks involved. Each aspect will be broken down to give you a clear understanding of which ETF might better suit your investment goals. And in the end, I'll provide a side-by-side comparison of investing $100,000 in each ETF over the long term. And get ready, one of these ETFs has the potential to reach a $10 million valuation and pay over $100,000 in monthly dividends. Before diving into the specifics of which ETF is better, let's set the stage with some background information about the two powerhouse funds. First, let's start with SCHD, the Schwab U.S. Dividend Equity ETF. Introduced by Schwab ETFs in 2011, this ETF aims to track the performance of the Dow Jones U.S. Dividend 100 Index. This index comprises 100 high-dividend-yielding U.S. stocks, making SCHD an attractive choice for investors seeking both income and growth. With an expense ratio of just 0.06% and over $54 billion in assets under management, SCHD is known for its low costs and high efficiency. On the other hand, we have NOBL, NOBL, the ProShares S&P 500 Dividend Aristocrats ETF. Launched in 2013 by ProShares, NOBL aims to track the S&P 500 Dividend Aristocrats Index. This index includes companies from the S&P 500 that have consistently increased their dividends for at least 25 consecutive years. Despite its higher expense ratio of 0.35%, the ETF has grown to manage over $11 billion in assets, reflecting its appeal to dividend-focused investors. NOBL's emphasis on companies with a proven track record of dividend growth provides an extra layer of security and predictability for investors. Both SCHD and NOBL provide unique approaches to dividend investing. SCHD's emphasis on high-yielding stocks provides substantial income, while NOBL's focus on companies with a long history of dividend growth offers stability and reliability. Understanding these differences is crucial for making an informed investment decision. Which brings us to each ETF's holdings and diversification. Starting with SCHD, this fund is known for its diversified approach to dividend investing. SCHD's portfolio is spread across various sectors with significant allocations in financials, healthcare, and consumer defensive. This sector diversification helps mitigate risk by not being overly exposed to any single industry. The top holdings in SCHD include some of the biggest and most stable companies. Home Depot and AbbVie each hold 4.12% of the portfolio, followed closely by Cisco Systems and Amgen Incorporated. The top 10 holdings make up about 40.29% of the total portfolio, providing a strong base of well-established companies. On the other hand, NOBL, the ProShares S&P 500 Dividend Aristocrats ETF, takes a slightly different approach. NOBL focuses on companies that have consistently increased their dividends for at least 25 consecutive years. This emphasis on dividend growth offers stability and a reliable income stream. NOBL's sector allocations include consumer defensive, industrials, and financials. Basic material and healthcare are also well-represented sectors in this ETF. The top holdings in NOBL are slightly more evenly distributed compared to SCHD. Leading the list are C.H. Robinson Worldwide, Walmart, and Essex Property Trust Incorporated. The top 10 holdings make up only 17.27% of the total portfolio, indicating a more balanced spread across multiple companies. Both ETFs offer substantial diversification, but they do so in different ways. SCHD's top holdings are more concentrated, which can lead to higher returns if these companies perform well, but also higher risk if they don't. NOBL's approach of spreading its investments more evenly can provide greater stability and reduce volatility, which can be appealing to more risk-averse investors. Furthermore, the sector breakdown of each ETF highlights their different investment focuses. SCHD's significant exposure to financials and healthcare sectors suggests a preference for stability and consistent income. In contrast, NOBL's heavy weighting in the consumer defensive and industrial sectors indicates a focus on companies that can weather economic cycles and maintain steady dividend payments. Now, in the end, I'll show you a side-by-side projection of both ETFs and see how this difference can end up being a difference of $5 million in valuation and $100,000 more in monthly dividends. Now that we've seen what's inside these ETFs, let's take a closer look at their investment strategies. Understanding the investment strategies of SCHD and NOBL is crucial for evaluating how each ETF aims to generate returns and manage risk. Both ETFs are passive strategies, but their approaches and focus differ significantly. Starting with SCHD, this fund aims to track the performance of the Dow Jones U.S. Dividend 100 Index. This index includes 100 high-dividend yielding U.S. stocks with a consistent record of dividend payments. SCHD's strategy emphasizes high current income and dividend growth, making it appealing to income-focused investors. The fund selects stocks based on 4 fundamental criteria: cash flow to debt, return on equity, dividend yield, and dividend growth rate. This approach ensures that SCHD holds financially robust companies capable of sustaining and growing their dividends over time. On the other hand, NOBL tracks the S&P 500 Dividend Aristocrats Index. This index comprises companies from the S&P 500 that have increased their dividends for at least 25 consecutive years. NOBL's strategy focuses on dividend growth and stability, targeting companies with a long history of reliable dividend payments. This emphasis on dividend growth helps mitigate risk, as companies that consistently increase their dividends are typically financially stable and resilient. NOBL's investment approach prioritizes quality and consistency, making it suitable for investors seeking steady, long-term growth. Both SCHD and NOBL use a rules-based approach to select and weight their holdings. However, SCHD's focus on high current income and NOBL's emphasis on dividend growth and stability result in different portfolio compositions and risk profiles. SCHD's strategy can lead to higher current yields, but may also involve more volatility due to its exposure to high-yield sectors like financials and energy. In contrast, NOBL's strategy of investing in companies with a long track record of dividend growth tends to result in a more stable and less volatile portfolio. Based on these strategies, let's see how they've performed in the past and what the future outlook looks like for these ETFs. Starting with the year-to-date performance, SCHD has achieved a return of 1.5%, while NOBL has slightly lagged behind with a return of 1.12%. This suggests that in the short term, both ETFs have performed relatively similarly, with SCHD having a slight edge. When we extend the timeline to 5 years, the difference becomes more pronounced. Over this period, SCHD has returned 2.62%, whereas NOBL has delivered a more robust 6.29%. This indicates that NOBL has had a significant advantage in recent years, likely due to its focus on companies with a long track record of dividend growth, which tend to be more resilient during market fluctuations. Looking even further back, the 10-year performance comparison tells a compelling story. Over the past decade, SCHD has yielded a return of 99.66%, while NOBL has outperformed with a return of 107.21%. This long-term data highlights NOBL's ability to generate substantial returns thanks to the strong growth of its high-quality, dividend-growing companies. So these returns are relatively close, but does that mean both will yield similar overall returns? The answer to that is no, because there are multiple factors to consider when dividend investing. In the end, I'll show you how other factors of these ETFs can significantly impact the final value, in fact, resulting in an additional $5 million in value. Now, when evaluating an ETF for investment, it's crucial to consider factors beyond mere share price growth. For instance, SCHD has demonstrated an average 10-year share price appreciation of 7.28%. Additionally, it offers a current dividend yield of 3.66% and has a dividend growth rate of 11.01%. In comparison, NOBL has a current dividend yield of 2.2%, alongside an impressive dividend growth rate of 15.98%. Over the past decade, NOBL has achieved an average share price appreciation of 7.64%. So let's calculate John's potential earnings from a $100,000 initial investment based on these figures. Starting with SCHD. In the first year, an investment of $100,000 in SCHD is projected to grow to approximately $110,940. After 10 years, the investment could increase to around $300,171. Extending the timeline further, after 20 years, the investment could grow to approximately $1,068,417. By the end of 30 years, the same investment could potentially reach an impressive $4,837,834, paying $434,483 in annual dividends. Monthly, this translates to around $36,207 in dividends after 30 years. The total value added by the investment over 30 years includes $2,172,545 from capital appreciation and $2,565,289 from reinvested dividends. The question is, can NOBL beat that? Let's break it down. In the first year, an investment of $100,000 in NOBL is projected to grow to approximately $109,840. Over a decade, this investment could increase to around $280,798. After 20 years, the investment could grow to about $1,120,683. Looking 30 years into the future, the same $100,000 investment in NOBL could reach a staggering $9,372,102, paying $1,617,624 in annual dividends, or around $134,802 in monthly income. The total value added by the investment over 30 years includes $2,975,656 from capital appreciation and an impressive $6,296,446 from reinvested dividends. Want to know which ETF can beat that? Click the video on the screen to find out.